How to Start Investing in Gold, a Beginner's Guide. You're seeing the headlines, hearing your group chat screaming, "Buy gold! It just hit another all-time high." By the time we're done, you'll have a simple three-step checklist taking you from clueless to confidently holding real gold, physical or digital. Your cash isn't growing very fast sitting in the bank, is it? Inflation is a silent thief, quietly swiping 3 to 4% of your purchasing power every year. And those high-yield savings accounts? They're paying pocket change, barely keeping pace. Gold, though, is different. Think of it as investment insurance. Even a modest 5 to 10% sliver of gold can smooth out wild market swings and protecting your wealth when everything else feels shaky. It's about smart diversification, especially since gold's price movements are often uncorrelated with stocks and bonds. Gold sounds good, but how do you actually get some? For beginners, we're sticking to 3 straightforward options. This is the classic "I want to hold it" approach, tangible gold like American Gold Eagles or a 1-ounce bar. Your best bet is to buy from a reputable national mint dealer online, like APMX or JM Bullion, or a well-established local coin shop. Expect a small premium, usually 4 to 6% above the spot price. That's the real-time market price. This covers fabrication, shipping, and the dealer's margin. Where to keep it? A secure bank safety deposit box or a hidden, bolted-down home safe are popular choices. A friendly warning: resist bragging about your assets on social media. Pros: zero counterparty risk. You own it outright, and holding gold just feels awesome. Cons: selling quickly means mailing it back or visiting a local shop. Plus, homeowners insurance typically caps theft payouts for precious metals, so check your policy. If secure storage and mailing gold sounds like a hassle, gold exchange-traded funds, ETFs, are for you. An ETF is a basket of assets that trades on a stock exchange, just like a regular stock. In this case, that basket holds actual vaulted physical gold. If you have a brokerage app, it's as simple as typing a ticker. GLD or IAU are 2 of the largest and most liquid gold ETFs. These funds track gold's price almost tick for tick. You can buy as little as $25 worth with a swipe, pay a tiny annual expense ratio, around 0.25% for IAU, and sell anytime the market is open. Pros: instant liquidity and zero storage headaches. Cons: you don't physically touch the gold, and there's a technical possibility of slight tracking error where the fund's price deviates from the spot price. Our third option: instead of the metal, you own shares in companies that dig it out of the ground. These are gold mining stocks, with big players like Newmont NEM miners offer built-in leverage. When bullion rises 10%, a well-run mining company's stock can sometimes jump 20% or more, as profit margins expand dramatically. Some even pay dividends. However, higher reward means higher risk. Poor management, rising operating costs, like oil or labor, or unexpected geological issues can clobber a stock, even if gold prices climb. You're not just betting on gold, you're betting on the company's ability to extract it profitably. All right, you've picked your method. Now for the nitty-gritty that saves cash. For ETFs or mining stocks, ensure your brokerage offers zero-commission trades. Most major players like Fidelity, Schwab, or Interactive Brokers do. If physical gold calls your name, compare at least 3 reputable dealers. Look for the live spot price, plus a premium under 6% for common 1-ounce coins or bars. Anything higher is likely gouging. Crucially, keep gold under 10% of your total investment portfolio. Gold is a diversifier and wealth protector, not a primary growth engine. You still want the bulk of your investments benefiting from long-term growth of stocks and bonds. It's about balance. Keep an eye on market trends and geopolitical events to make informed decisions. So there you have it, your beginner's roadmap to gold investing, demystified and ready for action. And remember, it's never too late to grow your wealth after 50.